Yo, yo, yo. CPA Strength here, back with another Accounting for Beginners video. I have the complete playlist over here of 140 something videos. In this video, we're going to do 5 transactions, and we're going to make journal entries out of the transactions. Then we're going to, after each transaction, we're going to show the effects on the income statement and the balance sheet. Also, the income statement and the balance sheet, I'm going to use the same one for further videos. So I hope you really enjoy this. I really spent some time thinking about it, and of course, we're going to use the DC Adler method. DC Adler: debit, credit, asset, distribution, expense, liability, equity, revenue. Now, the distribution could be a draw or a dividend, but it reduces the equity. So let's get into this. You've got a loan from bank for $40,000. That's our first transaction. Oh, also, in the description is going to be the transactions, also on the board. You can maybe look in the description, try to do the journal entries yourself, try to figure out what happens on the income statement and the balance sheet, and then watch the video. Or watch how you do. I guess do what you do, baby. Loan from bank $40,000. So we got a loan from a bank $40,000. Like I always say, most transactions are going to involve cash. So if you can know what the cash does, you're going to be good. So you got to know what the cash does. You got to know cash or money or checking account is an asset. If it's going up in value, you debit it. If the asset's going down in value, you credit it. So you got to know if money's coming in or money's leaving, what to do. So let's go. Loan from a bank, $40,000. What's going on? Loan from a bank. Are we getting money? Yes, we're getting money. How much are we getting? $40,000. What would our debit be? Cash, $40,000. Our debit's cash, $40,000, because we're getting a loan from the bank. If a bank's loaning us money, are we increasing our money or decreasing our money? We're increasing our money, and we know that money is an asset. Cash is an asset. So that's why we have money increasing, so it's an asset going up. And we're going to write in after our journal entry, we're going to say what bucket is it in. Is it an asset, expense, liability, equity, or revenue? Cash is an asset. Why did we get the money? A bank loaned it to us. So we owe them back. We have to pay them back. So that would be like a payable. That would be if someone loans us money and we got to pay it back. Or if we get a product or something, we got to pay it back. That's a liability. We're liable for it. We owe it. We owe for it. If this is this is the first transaction of our business. So we have liability going up. And that's going to be $40,000. But that's a loan from bank. So that's going to be our credit. Loan from bank. And it's a liability because we owe it to somebody. We owe it to the bank. That's going to be a liability. Debits and credits always equal. So if we have a debit of $40,000, our credit is going to have to be $40,000. So there's our first journal entry. Debit cash, $40,000. Credit loan from bank, $40,000, which is a liability. Alright, so now we're over to the balance sheet and income statement. We just started our business. We don't have anything because we have our first transaction. Now, after every transaction, I always like to see, I do on my QuickBooks or whatever. Every transaction you do is going to affect balance sheet or the income statement or both, and you want to see if you've properly placed things in there. So I think it's very important to see the relationship between the balance sheet and income statement. So our first journal entry, cash $40,000, which was an asset, and we debited that, we credited loan from bank for $40,000. We have an asset and a liability. Now, if an asset is debited, it's going to be going up. So we have cash as an asset. We're going to have cash here of $40,000. We also have loan from bank, liability for $40,000. So we have a liability also going up. We didn't have one, now we have, from our first journal entry, a liability of a bank, $40,000 going up. Loan from bank, $40,000. What's our total assets? $40,000. What is our total liabilities and equity? Because assets always equal liabilities and equity. DC Adler, debits equal credits. Assets always equal liabilities plus equity. So did we do everything right? Right? How did this affect? And it's only affecting the balance sheet. So total liabilities and equity. Well, we don't have any equity. The only liability we have is a loan from bank. So it's $40,000. Let's go to number 2. Number 2 is pay rent for office, $1,000. Do we have cash or money in this equation? Yes, we do. We have it as $1,000. Now we're paying rent because we need an office. We're doing a little accounting business right now. Don't get caught up really so much in the business, but get, just the transactions. Don't say, oh, that's a lot of money or that's a little bit of money. Just focus on the transactions, please. So we pay rent for office of $1,000. So we have $1,000 leaving because we got to pay rent. We got to pay rent for an office. So we have $1,000 leaving. And we've already explained. And if you're not sure of something, watch some of my older videos. But for purposes of time in the video and keep it moving, you have we already figured out cash as an asset. So we have, if we had cash, if we had an asset increasing, we debit it. But we're paying rent for office, so we're paying something. So we have our cash going out. We have our cash decreasing. So that's going to be a credit. So we're going to have cash of $1,000. And our second journal entry is going to be our credit. And we already know cash is an asset. So it's the debit. We're paying rent. We're paying rent. Now rent is an expense. An expense is a money outlay, an outlay of money, necessary and ordinary in your business. So, is it necessary and ordinary that I have an office that I pay rent for? Yes. So that would be an expense. Now we kind of already know because we did the credit. Now what I love about accounting is that it always balances and it always equals, and I just love that. Are we having fun yet? I'm having fun. Because rent is an expense. Is our rent expense category going up in value? Yes, because this is our first transaction. So it was nothing, now it's going to be 1,000, so it's going up in value. If an expense is going up in value, you debit it. So we're going to say rent is an expense of $1,000. Because debits always have to equal credits. Debit equals credit. pay rent for office $1,000. We're gonna debit rent for $1,000, and we're gonna credit the cash, which is an asset, for $1,000. All right, now we're gonna go for our second journal entry and how that affected the balance sheet and/or income statement. Our second journal entry was debit rent of $1,000, which was an expense, and we credited our cash of $1,000, which is an asset. So we know the income statement has expenses, so we don't have any expenses here, so we're gonna put on our rent of $1,000 under expenses. So we're gonna put rent $1,000. Now our income statement makes our net income, which is revenue minus expenses, which is our net income. So we don't have any revenue, unfortunately, right now. So we've got negative 1,000, and we use these parentheses in accounting for negative. I don't like that. We'll use parentheses to signify negative. So that's our income statement. Well, now we have, that's our debit. So now how our credit that affects, because every transaction is going to affect the balance sheet and the income statement. So we have credited cash of $1,000, which is an asset. If we credit the asset, that means it's decreasing in value. Our cash was $40,000, decreasing in value of $1,000, so our cash is going to be $39,000 now. Total assets, $39,000. And we have, under equity, is a net income that flows over from the income statement. We have net income over here. Our net income is, unfortunately, negative, signified by the brackets, $1,000. So we have $40,000 minus $1,000. So we have total liabilities and equity is $39,000. So does that match? Assets equal liabilities and equity, $39,000. So you have, so let's just take a look after these two transactions here. You've got your cash of $39,000. That's what you have for an asset. You owe $40,000 to somebody, and you only have $39,000. Number 3, buy office equipment for $5,000. We're gonna buy office equipment for $5,000. Do we have, if we're buying something, do we have money involved in this? Yes, we do. We're buying something for $5,000. So I'm getting the office equipment, we have money leaving. If we have money leaving, we know cash is an asset. If cash or asset is increasing, we debit it. If it is decreasing, we credit it. This is like a mirror, right? So we have buying office equipment for $5,000. So we have $5,000 leaving. So that would be a credit. Cash leaving, decreasing from our value because we had a certain amount. Now we have $5,000 less. So that is going to be a credit. So I always do the cash first when I'm doing a journal entry. So you got to know, it's going to be so helpful if you know cash or money is an asset. And if an asset's increasing, you debit it. If it's decreasing, you credit it. In this case, buy office equipment for $5,000, we're decreasing for $5,000. So we're going to have cash, $5,000. And we know it's an asset. Gotta know the cash. Gotta know the cash. Why did we spend $5,000 for office equipment? Now office equipment, you're just gonna have to stay with me now. And sometimes in accounting, or what I had to do, is I just had to go with stuff before I kind of understood it. But basically, The office equipment is gonna give us a value. We're gonna have it in our office for like 5 years. We'll say 5 years. We're going to expense it through the 5 years via depreciation expense. So we're going to expense it over time. But for now, it's an asset because it's going to provide us resources and value for a future time. So office equipment is going to be an asset, but it's going to be like a fixed asset that depreciates. So like I say, a vehicle, office equipment are big things that you would depreciate because you're going to get the value of it for like 5 years, 7 years. So it's just a more fair way to expense things over time than all at once. So office equipment is an asset. It's going to provide us value over time. We're going to say office equipment. That's going to be our debit because it is an asset, and we didn't have any office equipment and now we have $5,000 worth of it. Computers, desks, chairs, office equipment. $5,000. Debits always have to equal credits. And this journal entry is notable because you have 2 assets, 1 journal entry. And you have 1 asset increasing in value and 1 asset decreasing in value. So I think this is a very interesting journal entry. Let's go to our third journal entry here. We had office equipment $5,000, which is an asset. That's our debit. And then we had credit of cash $5,000, which is also an asset. So we have 2 assets, 1 journal entry. If it's debited, we know it's increasing. We have a whole new category of an asset. We have office equipment. We're going to put that under our assets. Office equipment, $5,000. But we have cash leaving. So we had $39,000 of cash, but now minus $5,000, we're going to have $34,000. So our total assets are still $39,000. And assets have to equal liabilities plus equity after every transaction, always, always, always. And our liabilities and equity, total liabilities and equity is $39,000. So we're good on that one. So you can see, and that had 2 assets, so that did not affect the income statement at all. Let's go to the 4th one. Pay internet service of $300. Once again, we go to the cash. What's going on to the cash? Do you have cash increasing or do you have cash decreasing? Well, you're paying internet services of $300. So you have cash leaving because you're paying for something. You're paying for somebody else's service. What is cash? Right. Cash is an asset. Is our asset increasing or decreasing? It is decreasing. We're going to have less cash after we pay somebody for a service. So if we have an asset decreasing, we're going to credit it. So let's go over here. Cash. We know it's an asset. And $300. You can almost go over here and just say, on the debit side, $300. What's going to be internet service? That's why we have a cash outlay, internet service. I have an office. Pretty much, I would say any business in the world now, you're gonna need, is it necessary and ordinary to have internet? Yes. So that's the definition of an expense, necessary and ordinary. So we're gonna say internet. And that's gonna be an expense. So is our internet expense is the first month? Is our internet expense category going up in value? Yes, it is. So if an expense is increasing in value, you debit it. So that's our journal entry there, our 4th journal entry. Now for our 4th journal entry, how it affects the income statement, balance sheet, vice versa. Let's see what we got. We had internet, we had our debit of internet for $300, which was an expense. and our credit was cash $300, which is an asset. So let's add our internet expense over here under expenses under the income statement. We're going to put internet. And that's going to be $300. So we have total expenses. We have no revenue. We have expenses of $1,300. So we have negative net income of $1,300. We haven't made any money yet, unfortunately. But hey, you gotta have faith when you're running a business here. You gotta have faith. You gotta pray every morning. Things are gonna work out for you, right? Let's go. So now, that's the first transaction. And that's gonna make our net income, or net income here. Our net income is on the income statement. It is also on the balance sheet. So that's why you can just that's why the balance sheet's the big dog, and you can see what's happening in the business by just looking at the balance sheet, because it incorporates the income statement. So we've got our net income of negative $1,300, and that means we've got liabilities plus equity is going to be $40,000 negative $1,300. So that's $38,700. Now we got to put in our cash. Cash was leaving our business. That's why we credited, but we had $34,000 cash minus $300 cash, so we have $33,700. So what's our total assets now? Our total assets is cash $33,700 plus office equipment $5,000, $38,700. $38,700. Does that equal total assets $38,700? Total liabilities and equity 30. Whoa! That's why you always gotta check. Sorry. Jeez, I'm $38,000. $38,700. Sorry about that. Yes, that matches. Number 5. Finally, I'm getting some money. Look, we got money, but it was for a loan. Then we got money going out, money going out, money going out. Finally, I get number 5. We get paid for bookkeeping $500. So we got money coming in. Finally, we got money coming in. About time, right? It's a struggle for a new business, I'm telling you. So we finally get money coming in. $500. We got cash coming in, $500. What are we gonna do? Alright, let's work the cash first. We know cash is an asset. If an asset is increasing, we're gonna debit it. So let's do it. We got cash increasing, finally let's debit it. Oh my god, right? Hey, what do we do? So we got cash, $500, and we know cash is an asset. Why did we get it? We got money coming in for a bookkeeping service. Now, in this example, number 2 is, I kind of like what I do. I have a CPA business, I do tax returns, I do bookkeeping, I do payroll for people. So, bookkeeping it's like, my regular job. So it's going to be a revenue. I got money for a service that I did for somebody. So it's going to be a revenue. And does that make sense? Because if a revenue is going up in value, thank God this is my first money. So if a revenue is going up in value, we're going to credit it. So we're going to say a revenue. Revenue over here, $500. Sorry, we got bookkeep. We're gonna say bookkeeping's why we got a revenue. Bookkeeping, $500, and it's in the revenue bucket. Let's go to our 5th one. All right, so our 5th and final journal entry of our little transactions is cash $500, which is an asset. And our debit, our credit is bookkeeping $500, which is a revenue. We finally got some money coming in. So let's put that under revenues, bookkeeping. That's our total income, Total revenue $500, $1,300 expenses. So we're at a negative $800 for our net income. Negative $800 for our net income. So we're going to change our net income over here. Now the parentheses signify negative in the accounting world. So what's our liabilities and total equity? $40,000, negative $800 for net income, $39,200. Now we've actually got cash, so we're gonna increase that. Thank goodness we got some cash, so we're gonna increase that by $500. So $33,700 plus $500 is gonna be $34,200. $34,200. Now our cash $34,200. Our office equipment is $5,000. It's going to be $39,200. And do our total assets equal our total liabilities and equity? Yes, they do. $39,200. I really hope you enjoyed this video. Please drop a comment about what you didn't understand. This accounting takes lots of practice. I'm going to try to do more. I'm going to keep the same balance sheet and income statement and do different transactions so we can see, so we can run through things. But anyways, thank you so much for watching. I love teaching, and it's really a blessing that I can give back to the world after I took so much for so many years. So anyways, until next time, deuces.